Welcome back to another episode of Smart Finance Insights Financial Aficionados. Today, we're addressing a dilemma that many people face. Should you invest your money or spend it to reduce debt? Before we discuss this important choice, be sure to subscribe and turn on the notification bell so you never miss out on our professional financial advice. Investing and debt repayment are important steps in your financial journey. Let's begin with comprehending the advantages of each. Imagine this. You have some money in your possession right now, possibly from a bonus at work, an inheritance, or a tax return. What will you do with it is the key question. Should you put it to work so you can perhaps see it grow over time, or should you pay off your current bills with it to lessen your burden? Let's evaluate our choices. 1. The power of investing. Investing is similar to sowing a seed and seeing it blossom into a wealthy tree. You can possibly increase the value of your money over time by investing it in the appropriate investment vehicles, such as stocks, bonds, or real estate. Imagine you have an extra $10,000. It could grow into a sizable sum if it is invested correctly rather than being left idle. Your money can eventually work for you, producing returns that could beat inflation. Despite brief volatility, history has demonstrated that the stock market has generally trended upward. Long-term growth has been profitable for patient investors who stick with it. It's crucial to keep in mind, though, that investing doesn't always lead to financial success. Markets can be unpredictable, and there is always some risk. The value of your investments may be impacted by market declines, economic downturns, and unforeseen circumstances. It's critical to diversify your portfolio by distributing your holdings across various assets, industries, and geographical areas. This can assist in reducing risk and the effects of a single investment's subpar performance. Your investment approach should also be in line with your financial objectives and level of risk tolerance. Consider more cautious investment options if you don't like the thought of market fluctuations and probable losses. Keep in mind that investing is not a way to get rich quick. It calls for endurance, investigation, and a long-term viewpoint. If you're new to investing, think about getting advice from financial professionals or using robo-advisors to assist you in making wise choices. 2. The freedom of debt repayment. On the other side, becoming debt-free can feel liberating financially. Imagine being debt-free and not having to worry about making payments each month. Carrying debt carries with it a certain burden. Debt, whether it be credit card debt, school loans, or a mortgage, can have a negative impact on your financial situation and sense of security. You essentially free up future money that would have gone toward interest payments by making debt repayment a priority. As a result, you will have more money in your pocket to save, invest, or spend on the things that are important to you, not to mention the effect on your credit score. A high credit score makes it possible to obtain loans with better interest rates and terms, as well as greater financial chances. Your financial stress is also decreased by paying off debt. You may concentrate on laying a more solid financial foundation now that the fear of being in debt is gone. It's crucial to recognize the many sorts of debt, though. High-interest loans, such those incurred through credit cards, can grow out of hand very rapidly. Perhaps paying them back first would be a wiser financial decision than investing. You can avoid spending significant sums of money in interest over time by paying off high-interest obligations first. So, before making investments, it might be a good idea to direct your resources on paying off your debt if you're carrying a large amount of debt with a high interest rate. 3. Striking the balance. How then do you find the ideal balance between debt repayment and investment? The solution depends on your unique circumstances and objectives. Investing and debt repayment must be carefully balanced, and a number of criteria must be taken into account. The interest rates on your obligations should be one of the first items you consider. If your loans have high interest rates, such as credit cards with double-digit APRs, you can end up paying more in interest over time than you would from investing. Long-term savings can come from prioritizing their payback. However, it's not all about the figures. Prioritizing the creation of an emergency fund should come before making any investing decisions. Being prepared with 3 to 6 months' worth of living expenses will help you avoid delving into your investments or taking on additional debt when unforeseen circumstances arise. Moreover, take your risk tolerance into account. Investments carry varied degrees of risk, so it's critical to consider your comfort level with possible losses. Risk-averse people may favor paying off high-interest debt before dipping their toes into the risky realm of investing. Allocating money to investments, though, may be more in line with your objectives if you're tolerant of market fluctuations and have a longer investing horizon. A balanced strategy is frequently advised by experts. Set aside some of your money for investments and debt payments. By doing this, you're taking care of your immediate financial needs while putting yourself in a position for future financial success. By lowering your debt, this technique can make you feel accomplished while allowing your investments to potentially grow in value over time. There is ultimately no universally applicable solution. Your financial path is individual, and the choices you make should reflect your beliefs, objectives, and environment. Before making any significant financial decisions, it is advisable to consult with financial experts who can offer specialized advice.